there are 6 neighborhoods that are still trending upwards when it comes to pricing in the city of Toronto. Some of them almost at double digits in terms of price growth year over year. We're talking about Weston, you're looking at Oakwood, the neighborhood of Mount Dennis, the neighborhood of Fairbank, the neighborhood of Keelsdale, just to name a few. We zoom in just to the city of Toronto, the average price being about $1,082,000, about $13,000 below overall average price in 2021. In 2021, we saw interest rates hovering around the 2% mark, and today we are at close to 7% on a fixed rate in many cases. So it's going to be interesting to see if we can hold that average price going forward this year. People are moving to where they can afford to buy real estate. Hey there, people. This is Josh, broker with Sage Real Estate and Garrison Collective. It is September 2023, and we are going to be reviewing the Toronto Real Estate Board's market stats update from August 2023. So let's jump into the 5 key under-the-radar takeaways from that report. So first off, sales continue to trend down month over month this year. We've been tracking that month over month and been watching these market updates, and they still continue to trend down. Why is that? Likely due to interest rates, with people who currently own homes not really looking to make that upgrade that they would normally make in a market where rates are a little bit more stable and quite a bit lower. So if someone were to have a 2.5% to 3% fixed rate mortgage, they don't have there's not a lot of incentive for them to necessarily sell and jump into a mortgage of 6.5%+ right now, especially if they have a year, 2 years, 3 years left on that rate. So the second key takeaway is that year-to-date pricing is also trending down. We were tracking that in our last market update, and we talked about that, how month over month average price continues to decelerate. Now, some of that is due to just seasonality. We've just gone through summer months, but it's going to be something to be interesting to keep an eye on as we move into the fall market, which is historically a bit of a busier market. If we look at last year's indicator of what to expect this coming fall, then perhaps we could also have a little bit of a stagnant fall with the current rates remaining elevated. And we're going to get into that rate discussion later on in this podcast. But the third key takeaway is that the average price year to date, when we look at the average price right now, the average price being about $1,082,000, it is about $13,000 below the overall average price that we had for the year in 2021. Why is that something that's worth keeping an eye on? In 2021, we saw interest rates hovering around the 2% mark, and today we are at close to 7% on a fixed rate in many cases. So when we look at what it costs to carry a house for around the same value, it is a very different market today. So it's going to be interesting to see if we can hold that average price going forward this year. The next under the radar takeaway from this report was that townhouse and condo sales are actually moving up. Now, pricing is still a little depressed in both condos and townhouses, but sales are moving up. And this is a very quick hot take as to why sales are moving up in townhouses and condos is simply due to affordability. In most cases, condos and townhouses are trading for below that $1 million mark. So it means that people are able to put smaller down payments down because they no longer have to get to that 20% threshold that you have to do when you're buying a property over $1 million. So it makes it a little bit more affordable. You also are able to get mortgage insurance to kind of cover off that mortgage. And then when you look at fixed rates online, generally insured mortgages, you're getting a little bit of a lower rate. It's really, again, proving my point. If you've been following this channel, last month we were talking about how condos specifically are something to keep an eye on because they're a very affordable segment of the market. We're going to see more and more buyers flocking towards townhouses and condos just due to affordability. Last key takeaway is that there are 6 neighborhoods that are still trending upwards when it comes to pricing in the city of Toronto. Some of them almost at double digits in terms of price growth year over year. Which of are those 6 neighborhoods? We're going to jump into right now. But spoiler alert, 4 of those neighborhoods are under the radar neighborhoods that we've been covering in this channel. These neighborhoods are showing tremendous growth and are almost inflation busting neighborhoods. So what are those 6 neighborhoods? So when we look at the map of the city of Toronto, from a real estate standpoint, they classify them with a letter and number. So W for West, C for Central, which are the kind of central neighborhoods in the city of Toronto, or E for Eastern, more Eastern neighborhoods. So 4 of the neighborhoods are in the northwest pocket of the city. You can probably see the map right over my shoulder right here. So we're talking about W03, W04, W09, and then CO3 kind of right here in the center. So W03, we see average sale prices up over 7.51% year over year. W04, prices up 5.97% year over year. W09, prices up 6.82% year over year. And then CO3, prices coming in just a hair under 7% at 6.96% year over year of an increase. So tremendous growth in these neighborhoods. And why is that? Well, you should watch some of the other videos we have on this channel and you'll understand why these neighborhoods are under the radar. The key is most of these neighborhoods follow that Eglinton West. I'm talking about Weston. You're looking at Oakwood, Cedarvale, the neighborhood of Mount Dennis, the neighborhood of Fairbank, the neighborhood of Keelsdale, just to name a few. These neighborhoods we've talked about over and over on this channel that I've been saying for months. These neighborhoods are under the radar and they're trending upwards. When we look at these neighborhoods versus the rest of the city, we're seeing, for the most part, negative growth, prices down 2 to 3, 4% year over year in most of the kind of more trendy neighborhoods, and the rest of the city of Toronto being fairly flat. These neighborhoods are completely knocking those neighborhoods out of the park, and it's due to growth. These neighborhoods have the brand new transit options, and because the average price of a detached, semi-detached home and even condos in these neighborhoods is below the overall average in the city of Toronto, we're actually seeing more price growth there because people are moving to where they can afford to buy real estate. And these are the places that people are moving to, and there's still tremendous price growth in these neighborhoods. So you've got to keep an eye on them. Oh, and not to leave the East End out of the equation, the other 2 neighborhoods are out in the East End. So we're looking at the neighborhood E05. It's up 7.23% year over year. And then E10 is up 8.66%. So we're nearing 10% in the neighborhood E10. So what are these neighborhoods? So E10, we're looking at West Hill, Rouge Valley, so very far east, pretty much borderline Pickering that we're looking at in E10. So that's kind of Lawrence Avenue East, Kingston Road, kind of that pocket of the city. And then when we look at E05, it's pretty much bounded by, let's say, like the 401 at the south end, all the way up to Steeles, between like Pharmacy and Kennedy in the East End. So these 2 neighborhoods, again, inflation busting neighborhoods that are beating the rest of the city. And again, it's due to affordability. People are looking in the neighborhoods where they can afford to buy. So keep an eye on all these 6 neighborhoods moving forward. And on our channel, again, we focused on the West End a little bit more. So keep watching this channel. We're going to keep updating you on those under the radar neighborhoods. So before we jump into our next segment, let's quickly just review the numbers. We went over our takeaways pretty quickly. Most of you here are actually to hear what are the actual numbers overall in the city of Toronto. So let's jump into those numbers. So if we look at the year over year summary, let me zoom into it here. Hopefully it's back on the screen. You can see it right here. So we're looking at sales for August are down 5.2% when we look at it from a year over year basis. News listings up 16% year over year. Active listings also up 16.5% year over year. We're seeing the market shift quite a bit. So it's going to be interesting to see if the fall market will absorb a lot of those new and active listings that are currently on the market. The average price is flat, as we mentioned before. We're not seeing much growth. And when we look at the numbers from last year. When we looked at the month-over-month numbers, we're trending in the same direction as last year. So again, be interesting to keep an eye on what that number looks like when we head into now September, October, November, which are the 3 generally busier months of the fall market. Now we zoom in just to the city of Toronto because we are based in the city of Toronto. So we look at the average price of a detached house is just over 1.6 million, which is actually down almost 1% year over year. Semi-detached at 1.235 million. Now that's up 9% year over year. And like we just talked about just a few seconds ago, there's a bit of a flight to what you can afford. So a lot of people are getting priced out of the detached market, moving into the semis, and then eventually moving into townhouses, condos, so on, right? So when we look at the townhouse market, also up 6.2%. It's that flight to where you can afford. Condos are down about 2%. Condo pricing is coming down. Sales are going up, so it's going to be interesting to see how the condo market's kind of that funky, weird market where pricing is going down, but sales are going up. Who knows how that works, but interesting to keep an eye on both the condo and the townhouse market as we move forward, as rates, for now, are being held, or as rates continue to increase. So before we jump into the Bank of Canada rate announcement, which we're going to get into in 1 second, let's quickly review the rental market, because once we get into this Bank of Canada announcement, if we understand the rental numbers, you'll have a better idea, you'll have a better understanding of why the Bank of Canada rate announcement affects the overall housing market and not just buying and selling of homes. So let's look at the rental numbers really quickly from the city of Toronto. These numbers were provided by rentals.ca. So we look at the average price of a rental in the city of Toronto is $2,849. That's for all different sizes put together. When we look at a one bedroom, just over $2,600 a month for a one bedroom apartment. Now, to put that into perspective, when I started in real estate a decade ago, to rent a one bedroom apartment in the city of Toronto was around $1,200 to $1,300. So we have doubled in 10 years for what it costs to rent a one bedroom in the city of Toronto. And the unit sizes really haven't changed all that much. It's really just the market itself and the housing squeeze and the housing crunch we're in that has driven this number double of what it was a decade ago. When we look at two bedrooms, averaging almost $3,400 a month at $3,386, and three bedrooms, surprisingly enough, sitting at $3,729. So if you look at the average price of a one bed and two bed, three bedrooms, that number doesn't pop out as much as the one bedroom or two bedroom rentals, but still at $3,729 a month, it's not a small amount of money, especially when we look at these are mostly families who are going to be renting these, and that's taking a huge chunk out of a family's budget just in living expenses, just having a roof over their heads. So we've got to find a way to get these numbers under control. So that leads me into the Bank of Canada announcement. So any of you who follow realtors online, on Instagram, on TikTok, wherever, realtors were jumping for joy at the fact that the Bank of Canada held rates at 5%. Me being a skeptical human being, I looked at that, I'm like, well, great, we're holding at 5%. 5% is not like, it's not a little number, it's still quite a big number, and it's still going to cost people a lot of money to borrow from the banks when the prime rate is 5%. However, when we dug deeper, and listen, the hold at 5%, one of the takeaways I have from that is that, number one, it's going to give some temporary relief to people who are on variable rate mortgages. Variable rate mortgages are influenced by the prime rate, so at least it's going to give them some temporary relief. They don't have to look at their interest rate payment jump month over month as it has been for them now, a year and a half. So it gives them a little bit of temporary relief until that next announcement, which is October 25th is the next announcement. So at least for the next month, they can hold their breath and try to kind of catch up on their debt payments and so on and so forth. However, again, me being the skeptical person I am, I started looking into, okay, so what does this rate hold mean? Now, the Bank of Canada, in their announcement, the title of their announcement saying they are continuing quantitative tightening. So if you have any basic understanding of economics, our previous cycle, pandemic and before the pandemic, we are in quantitative easing. So the prime rate, the lending rates were always fairly low. They were anywhere from 0 to 2%. They kind of were easing the market, trying to stimulate the economy, trying to stimulate people to buy more, take on larger debt loads, take on more risk. So they wanted to make sure the interest rates were low, where people could innovate and drive the economy forward. In a quantitative tightening environment, they're going to keep raising rates to try to bring that inflation number down, right? So they don't want people to be taking on larger debt loads. They want people to be able to pay off their debts, to not be spending frivolously. They want to really bring that inflation number in check, and the tool that the Bank of Canada uses is quantitative tightening, and that's where we're in right now. Now, in their announcement, they mentioned that they are putting a temporary hold on rates. Temporary hold. So that means that October 25th announcement date, could it mean another hold? We'll see. I mean, the way the bond market reacted to this announcement, and one person that you guys should all be following, either on Instagram or I think he's on TikTok as well. He has a podcast, Daniel Foch. He right away jumped onto Instagram and talked about this, how the bond market, the way they reacted to this Bank of Canada hold, the bond market actually went up. And the thing is, with the bond market moving up, when we look at fixed rate mortgages in Canada, fixed rate mortgages are determined in large part by the bond market. So with the bond market moving up, fixed rate mortgages are also moving up. So yeah, great temporary relief for those on a variable rate. However, while all the realtors were cheering that there was a hold on the Bank of Canada rate, most of our clients, if they are looking at a fixed rate mortgage, the cost for them to borrow just went up because the bond market reacted completely different to the Bank of Canada, because the bond rate is generally a leading indicator. So that means the bond rate seems to think the Bank of Canada will likely have another interest rate raise when that October 25th announcement rolls around. I'm not here to predict what's going to happen. However, those of you who are in the real estate market right now, just keep close tabs on this to see kind of where that goes. All right. Many of you are watching this to try to get answers, right? You're trying to put a roof over your head. You're maybe trying to make that move up buy. You may be trying to get into the rental market. You may be trying to rent a place. You may be trying to sell your place. You may be on a variable rate mortgage and you just simply can't afford these payments anymore. How do we get out of this mess that we're in? I mean, there's a few things that you've probably read online or in newspapers or whatever. My opinion on where things need to move next to get ourselves out of this housing crunch we're in. I think first off, and this is something that's been being debated right now in the media, there's a huge spotlight on it, is we need to build more housing. I mean, as simple as that. If we create more supply, that removes some of the demand from the market, that should put some pressure on pricing to bring those prices down. There's more options for consumers. That'll create a more competitive environment and should hopefully bring prices down. Now, supply doesn't come quickly, right? A lot of the stuff that they're talking about now, I mean, the city of Toronto just said they wanted to add an additional 25,000 rental units to the, I think, 40,000 they already announced. 65,000 new rentals, great. When are those going to be delivered? If they're in high-rise buildings, those of you who are in the real estate market understand that high-rise buildings take a long time to complete. We're looking at anywhere from like 3 to 7 years for a high-rise building to complete. We need housing right now. What are we going to do to add new housing right now? I mean, we've needed it yesterday. So what are we going to do to create that right now? I mean, they're already started to change some zoning laws, add laneway housing. I think the biggest thing is for us to be able to change the zoning to allow more duplex, triplex, fourplexes in neighborhoods. That's a quick way to add more housing. So governments of the world, anyone watching this, if you know someone in government, If you just want to write a letter to a politician in your area, ask them to find ways to expedite building more of these duplex, triplexes, fourplexes in neighborhoods to get more homes built right away. That's what we need. If you're out there looking to get into the real estate market, if you're looking to buy or rent, one thing to do is perhaps to start looking out for different opportunities, whether it be downsizing. So if you're a family and you really want a 5-bedroom home and it's not attainable, perhaps going into that 3-bedroom home is the way to go, or even a 2-bedroom home, especially if your kids are small and they don't mind living in bunk beds for a few years. Perhaps that downsize could help. So moving from a larger property to a smaller one to save a little bit of money and to just kind of take that short-term pain for perhaps a longer-term game where you can save a little bit of money month to month by looking at just a smaller option. Another thing is looking at emerging neighborhoods. We talked about it earlier in this market update. Those under-the-radar neighborhoods, that pricing is actually trending upwards in some of these neighborhoods. So perhaps I'm not picking on neighborhoods right now, but I live in the West End, so I know these neighborhoods quite well. So perhaps instead of looking at a neighborhood like Witchwood, beautiful neighborhood right on the Sinclair streetcar line, you can get downtown from Witchwood in 20-30 minutes. I have a lot of clients that live there and have lived there for many years. However, if you're a new buyer trying to get into that neighborhood, it's extremely difficult. Even today in this environment, house prices average well over 1.5 million in the area. However, if you moved just a little bit further west, and if you went into an area like Fairbank, Keelsdale, a very similar house that you'd buy in Witchwood for 1.5 million would cost you 1.2, 1.3 million if you moved a kilometer further west. So perhaps it's looking at these emerging areas where you get the added benefit of you're getting a similar type of property for much less, but also in an area that's trending upwards. So your investment, you can actually make a ton more money looking at these emerging areas currently right now. So you'd have the added benefit of you're buying a little bit lower, you're still riding an upwards wave in terms of price where everything else is going down. And then when interest rates start to come down, these neighborhoods will look even more attractive to some of the new buyers that are looking at a new rate environment, and you can make a heck of a lot more money on your investment. So a couple of ideas that could help potentially move the needle and help people find a home in this market. Oh, and before I get into that, I said I was going to talk about rentals. The same things I talked about from the buy side apply to rentals. So perhaps instead of looking at that 3-bedroom rental, look at a 2-bedroom. And again, looking in the emerging areas for rental. Yeah, it's great to live near Trinity Bellwoods and some of the very trendy neighborhoods downtown, but if you move a little bit further northwest or a little bit further east, you can find very suitable options in these neighborhoods. And renting, it's even shorter term. So rental market can change on a dime, right? So for what perhaps you're having to move further out east to find a rental right now, or further west than you'd like, but rentals, they're generally just 1-year leases. So you sign your 1-year lease, wait till next year. If the rental market looks better in some of the neighborhoods you really want to be in, then you move back to the neighborhood you want to be in after a year. Maybe just don't unpack all your boxes. So that's it for the market update for, it's September 2023. We were looking at the August 2023 numbers. If you liked this podcast, if you're like me, if you want to work with myself or my team, we'd be more than happy to be your real estate resource for the city of Toronto, especially in some of the under-the-radar neighborhoods. So if you're looking to buy, sell, rent, invest, whatever, feel free to reach out anytime. The Calendly link is below. Feel free to click it and book a time to chat. We'd be more than happy to help you out. So that's it. Again, I'm Josh, broker with Sage Real Estate and Garrison Collective. Peace out.